Well, I think this is the point. I think looking at yield curve control right this moment is not something that's necessary, but it's about whether you put that control in place before the market pushes it away so that it's there and you don't have to think about it, or whether you sit back and use other measures. But I think you're probably right at the end of the day that whether they implement yield curve control now or not, the market is not likely to take us out of a range that would be consistent with that anyway. So, it's almost like a safety brake at this point. You could put it on, but if the car isn't moving, it doesn't really matter.
Hang on a second. Are we suggesting now that the yield curve has to be manipulated going forward because we cannot trust the discounting mechanism of the market to correctly judge the correct level of the underlying bond and therefore the yield on the back of that as well? Are we saying the market is redundant now and this needs to be manipulated by central banks?
Well, I think it's a fact of the matter that given we have no more policy rate at the front end, it's zero and there's nothing else you can do, you move that policy target further and further out the curve. So the same way we used to manage the overnight rate, we now have to manage something else. And in most circumstances, you can still do that without any sort of firm bits. You look at QE, which is just buying across the curve. If we get to a situation where we think that those market rates should be lower to generate the economic recovery, the same way we would have cut the Fed funds rate, 100 basis points over the course of a few months to generate growth, well, now we may need to cut the 10-year rate by 50 basis points to generate sufficient growth. So I think that's the nature of the world that we live in, given how much the policy options have been limited now.
Given where we are historically, normally you and I at this stage of a presidential election year will be talking about the Fed just holding off and not wanting to influence election matters with central bank policy. That's what we'd have talked about every 4 years normally as well. But it's different this time on that front, isn't it?
I think the Fed always does what they need to do, but we know as you get closer in, if the status quo is okay, you don't really see the Fed tend to shift one way or the other. But I think in this situation, the status quo is the Fed is easing and the Fed is dovish, and so particularly in September, I don't think there's any issue whatsoever doing what they need to do. But if they can get their bigger decisions out of the way in September, then that probably leaves them as we get into October and November a bit more on the sidelines and running policy until we see exactly how the data pans out and where COVID goes at this point. But I think September is still far enough from the election that there's really no one concerned about political issues around the Fed here.
If we get a stimulus package, and I think Nancy Pelosi said, we'll meet you halfway. Well, where are they at the moment? They're $3.5 trillion. The Republicans are about $1 trillion as well. Let's say we settle on $1.75 trillion, something like that. What does that do to asset classes? Anything?
I think it does have a significant hit now, just for two reasons. The one is we've definitely seen the expectations fall that we would get something, and that we would get it in an even longer time period. So that gives you a little bit of a boost that people have discounted it a bit more. And I think the other side, even if you look at that, if you get something between $1.5–2 trillion, which seems to be the landing zone right now, given where you've seen Republicans give in a bit, and the Democrats are now willing to get under 2 in terms of what their headline number is. This was a market that was actually coming in thinking it was going to be more like $1 to $1.5 trillion. Didn't think the Democrats were going to get in there. So it's actually bigger than what people were talking about a month ago. So at the end of the day, yes, I think that overall fiscal policy really has a lot more impact and is much more important right now than the Fed, given what we've already talked about of some of the more limited abilities of the Fed at this point. So delivering that fiscal stimulus is more important. And so, you would expect it to feed back into equities, which means you're feeding into that reflation trade and you're getting break evens widen. You're hopefully at some point getting EMFX. That's the side that hasn't necessarily gotten along with there. So the reflation trade, I think, is really anchored to what can fiscal stimulus deliver, whereas I think the Fed is going to drive the real rates trade. So that's your gold trade and your tips trades.